If you own residential or commercial rental real estate, the Tax Cuts and Jobs Act, known as TCJA, has changes that you need to know about. I have discussed the difference between passive and active income in my earlier Tax Consequences of Fix and Flip presentation, but I would like to go over the terms again here. In many cases, real estate is considered a capital asset, and to understand if you should flip or rent houses, you need to understand the difference between passive income and active income. Active income. This is income that comes from our active efforts to earn money, such as working at some sort of a traditional job. Passive income. This is earned when you put your money to work for you. Now, properties held for more than a year and rented to tenants or even lived in by the investor can help push a deal into that passive investment category and subject to favorable capital gains tax between 0 to 20%. If the property is held less than 12 months, the short-term capital gain is taxed at ordinary income tax rates. However, you do have the benefit of not paying self-employment tax, so they are good savings nonetheless. Vacation home owners may choose to rent out their properties to offset the expenses of ownership or to generate income. Depending on the number of days each year that a property is rented out, the owner may be entitled to certain tax benefits. If the vacation home is used exclusively for the owner's personal enjoyment and it is not rented out at any time during the year, the owner can generally deduct real estate taxes and interest on a home mortgage. Like a primary residence, the costs associated with insurance, maintenance, and utilities cannot be written off. If the home is used for rental purposes and is rented out for 14 days or less each year, according to tax laws, there is no need to report that rental income. In this case, the house is still considered a personal residence, so the owner can deduct mortgage interest and property taxes on Schedule A under the standard second home rules. However, the owner cannot deduct any expenses as rental expenses. This tax break is sometimes called the master's exemption, since homeowners close to the Augusta National Golf Club can earn as much as $20,000 renting out their homes during the annual tournament without having to report the income on their tax returns. Under prior law, you can still deduct mortgage interest and state and local real estate taxes on rental properties, while the TCJA imposes new limitations on deducting personal residence mortgage interest and state and local taxes, including personal residence real estate taxes. Those limitations do not apply to rental properties unless you also use the property for personal purpose. In that case, the new limitations could affect deductions for mortgage interest and real estate taxes that are applicable to personal use. In addition to the deductible items I mentioned earlier, landlords also get the benefit of depreciation. Essentially, this means you get to write off the entire value of the home, but not the land, and spread out over 27.5 years. When you convert a home you lived in, your depreciation is based on either the cost of the home plus any improvements you've made, or its current market value when it becomes a rental property. You'll use the lesser of the two divided by 27.5 to find your annual depreciation amount. Most landlords who pay a mortgage end up with a net loss at the end of the year. Keep in mind that this isn't an actual loss, since depreciation doesn't represent an out-of-pocket expense. On the contrary, the value of the property should increase over time. If your rental property does show a net loss, you can use up to $25,000 of losses to offset other income you have. In other words, if your rental property shows a net loss of $10,000 and your AGI is $60,000, it reduces your AGI to $50,000. You will need to know the tax implications when you eventually sell the property, which depend on how long you lived in it and how long you rented it out. If you lived in the home for at least 2 years and rented it out for no more than 3 years, you may be able to exclude up to $500,000 in gains from the sale from taxable income, since the home still meets the definition of a principal residence. However, if you don't meet these criteria, any profits are subject to capital gains tax. In addition, you owe the income tax on the amount you have claimed as depreciation throughout the years, which is actually taxed at your ordinary income tax rate. This is called depreciation recapture. This is true whether or not you qualify for the principal residence exclusion. As I mentioned, there is a pretty long list of expenses you can deduct from the rental income your home generates on Schedule E of Form 1040. Basically, you can deduct all the costs associated with owning, renting, and maintaining the property other than the cost of the property itself. The list can include, but it's not necessarily limited to, mortgage interest, property taxes, HOA fees, insurance, property management fees, cleaning and maintenance costs, pest control, cost of repairs and supplies, trash removal fees, travel expenses if the primary purpose of the trip is related to renting the property, any utilities you pay, yard maintenance. As I have mentioned, people who own their own businesses are required to pay Social Security and Medicare taxes on their net business income, as well as income taxes. These taxes are commonly referred to as self-employment tax. One of the nice things about owning rental property is that rental income is ordinarily not subject to self-employment tax, only income tax. However, there is one exception for landlords who provide substantial personal services to their tenants and are effectively running a bed and breakfast business or a hotel, not a normal rental operation. Also, some taxpayers occasionally buy and sell houses or other real estate as an investment rather than as a business. Facts and circumstances, including the number and frequency of houses bought and sold, the taxpayer's involvement in any rehab decisions, and the taxpayer's intent determine whether the activity is an investment. The new tax law includes several expanded breaks for real estate owners and one important negative change, the new loss limitation rule. Lower ordinary income tax rates for years 2018 through 2025. If you own property as an individual or via a pass-through entity, meaning a sole proprietorship, a limited liability company treated as a sole proprietorship for tax purpose, a partnership, an LLC treated as a partnership for tax purposes, or an S corporation, net income from rental properties is taxed at your personal federal income tax rates. This is a temporary change since in 2026, the rates and brackets that were in place for 2017 are scheduled to return. The TCJA retains the 0%, 15%, and 20% federal income tax rates on long-term capital gains and qualified dividends, including long-term gains from real estate. There is an exception, as under prior law, you still face a 25% maximum federal income tax rate instead of the standard 20% maximum rate on a long-term real estate gains attributable to depreciation deductions. For qualifying property placed in service in tax years beginning after December 31st, 2017, the TCJA increases the maximum Section 179 deduction to $1 million, up from $500,000 for tax years beginning in 2017. The Section 179 deduction potentially allows you to deduct the entire cost of eligible property in year one. For real estate owners, eligible property includes most improvements to the interior portion of a non-residential building if the improvement is put to use after the date the building was put to use. The TCJA also expands the definition of eligible property to include expenditures for non-residential building roofs, heating, ventilation, and air conditioning equipment, fire protection, and security systems. Previously, one significant limitation on Section 179 was that rental property owners could not use it to deduct the cost of personal property used in residential rental units. The TCJA eliminates this restriction starting in 2018. Thus, starting in 2018, landlords may use Section 179 to deduct up to $1 million in personal property in rental units each year. For example, Section 179 may be used to deduct appliances and furniture in rental units. You can deduct up to $1 million, but not below zero, using the Section 179 deduction, as long as you spend no more than $2,500,000 on capital purchases for your business. Warning: Section 179 deductions cannot create or increase an overall tax loss from business activities, so you may need plenty of positive business taxable income to take full advantage of the Section 179 deduction. Your CPA can help you assess this issue. For qualified property placed in service between September 28, 2017 and December 31, 2022, the TCJA increases the first-year bonus depreciation percentage to 100%, up from 50%. The 100% deduction is allowed for both new and used qualified property. The 100% bonus amount is scheduled to remain in effect through 2022. It will gradually phase down to 0% by year 2027. Bonus depreciation may not be used for real property, except for real property improvements such as landscaping or grading, which has depreciation period of 15 years straight-line depreciation, and other components that have a depreciation period of 20 years or less. Thus, landlords may not use it to deduct the cost of their rental buildings or major building components. However, landlords can use bonus depreciation to fully deduct in 1 year the cost of personal property they use in their rental activity, such as appliances, laundry equipment, gardening equipment, and furniture. Section 179 can also now be used. Listed property must be used over 50% of the time for business to qualify for bonus depreciation. Listed property includes cars and entertainment property like televisions and cameras. Computers were classified as listed property as well, but the TCJA removes them from this classification starting in 2018. Thus, bonus depreciation may be used to deduct computers used less than 50% of the time for rental business. If your rental property creates a net loss, and most do at least during the early years, things get complicated. The passive activity loss rules will usually apply. In general, the passive activity loss rules only allow you to deduct passive losses to the extent you have passive income from other sources, like positive income from other rental properties or gains from selling them. Passive losses in excess of passive income are suspended until you either have sufficient passive income or sell the properties that produce the losses. After you have successfully cleared the hurdles imposed by the passive activity loss rules, the TCJA establishes a new hurdle. For tax years beginning in 2018 through 2025, you cannot deduct an excess business loss in the current year. I will go over an example in the next slide, but here is the definition. An excess business loss is the excess of your aggregate business deductions for the tax year over the sum of your aggregate business income and gains for the tax year plus $250,000 for single filers or $500,000 if you are a married joint filer. The excess business loss is carried over to the following tax year and can be deducted under the rules for net operating loss carry-forwards. Here's a key point. This new loss deduction rules applies after applying the passive activity loss rules. So if the passive activity loss rules disallow your rental loss, you don't get to the new loss limitation rule. Let's say Paul is an unmarried individual who owns 2 office buildings. In 2018, he has $500,000 of allowable deductions and losses from the rental properties after considering the passive activity loss rules, and only $200,000 of gross income. So he has a $300,000 loss. He has no other business or rental activities. Paul's excess business loss for the year is $50,000. $300,000 loss minus the $250,000 excess business loss threshold for an unmarried taxpayer. The $50,000 excess business loss must be carried forward to Paul's 2019 tax year and treated as part of an NOL carry forward to that year. Under the TCJA's revised NOL rules for 2018 and beyond, Paul can use the NOL carry forward to shelter up to 80% of his taxable income in the carry forward year. Important: if your rental loss is $250,000 or less, you will not have an excess business loss and you will be unaffected by the new loss limitation rule. The idea behind this new loss limitation rule is to further restrict the ability of individual taxpayers like yourself to use current year business losses, including losses from rental real estate, to offset income from other sources, such as salary, self-employment income, interest, dividends, and capital gains. The practical result is that your allowable current year business loss, after considering the passive activity loss rules, cannot offset more than $250,000 of income from other sources or more than $500,000 if you're a married joint filer. Under the prior law, a net operating loss could be carried back 2 years, resulting in a refund of all or part of the taxes paid in those years. The TCJA eliminates carrybacks of NOLs. That is, they may only be deducted in current and future years. Also, the TCJA permits taxpayers to deduct NOLs only up to 80% of taxable income for the year. Unused NOL amounts may be carried forward and deducted in any number of future years. For real estate professionals, as I have mentioned, the TCJA contains 2 limitations on deducting business losses, including losses from rental properties. These limit deductions for any rental losses after the application of passive activity loss rules, which restrict rental property owners' ability to deduct rental passive losses from non-rental active income. These new limits are of particular importance to rental property owners who qualify as real estate professionals, since the passive activity loss rules do not limit their ability to deduct losses from rental activities in which they materially participate. Thus, for 2018 and later, there are now limits on real estate professionals' ability to deduct rental losses from their non-rental income. New limits on interest deduction. Starting in 2018, all businesses with average gross receipts of $25 million or more are allowed to deduct interest payments only up to 30% of their adjusted taxable income. Income including depreciation, interest expenses, pass-through deductions, or NOLs. Interest that's not deductible in the current year must be carried forward to be deducted in future years. However, real property businesses may elect out of this prohibition and thereby deduct 100% of their interest expenses each year. To do so, they must depreciate their real property under the longer periods required by the ADS, Alternative Depreciation System. 30 years instead of 27.5 for residential property, and 40 years instead of 39 for non-residential property. Also, such electing businesses may not use bonus depreciation. Like-kind exchange is still allowed for real estate. Prior to the TCJA, taxpayers could exchange like-kind business property and defer any gain until the property was ultimately sold. Property that was eligible for this tax-free exchange included both real and personal property. Under the old law, you could exchange a building for another building or exchange a vehicle for another vehicle, assuming all property is business use property. This is known as Section 1031 exchange. However, for 2018 and beyond, the TCJA eliminates Section 1031 exchange treatment for business use personal property. The vast majority of rental activities qualify as businesses or investment activities. However, rentals that are not profit motivated must be classified as hobbies. Under the prior law, expenses from a hobby could be deducted as a personal itemized deduction on Schedule A to the extent they exceeded 2% of the taxpayer's adjusted gross income. However, such deductible hobby expenses could not exceed hobby income. The TCJA completely removes the personal deduction for hobby expenses. This means that while the income from a rental activity classified as a hobby must be reported and taxes paid, but no expenses may be deducted. I wonder how many taxpayers will report hobby income from now on. There will be more presentations talking about the new tax changes coming up, so please subscribe and give me a thumbs up.